As you can see, ESG can impact many aspects of a business, both internally and externally. Let's explore some emerging trends, consistent across all industries and relevant to fund performance across asset types. Climate change strategy. Investors across industries are demanding greater action, greater disclosure, and more investment in managing the impending risks of climate change. Increased attention to the S&G. Although climate has been deemed the existential crisis of our time, and in turn an existential crisis to corporations, social and governance issues, such as employee welfare and diversity, equity, inclusion, and social justice, all are increasingly becoming material. For example, South Africa's biggest retailers stopped selling an American hair product brand due to perceptions of racist marketing and advertising. Transparency and disclosure. Stakeholders across the board, ranging from investors to consumers, are demanding greater transparency and disclosure on product labeling, operations, sourcing, employee demographics, and etc. Analysts are specifically looking for greater detail on the company's ESG strategy, oversight protocols, the quality of their data, and their KPIs and associated metrics. Long-term ownership mindset. Investors are looking for management quality indicators beyond quarterly returns and stock prices. Investors are expecting compensation structures to be tied to longer time horizons that allow ESG efforts to bear fruit, reducing the likelihood of questionable corporate behavior to spike quarterly numbers. Fund performance. ESG funds outperformed the markets and conventional indices during the COVID-19 pandemic in 2020, a historic human health and economic catastrophe whose impacts mirror that of the Great Recession. Investors, analysts, and corporations attribute this performance due to the greater sensitivity ESG-centric companies have in navigating and adapting to macro-level market and non-market changes. Both investors and corporations are creating coalitions and cross-sector partnerships to continue advancing ESG's popularity, adoption, and standardization, as well as advancing the notion of stakeholder capitalism to address world challenges. Here are some examples of these initiatives, including Investor Initiatives, PRI, the Principles of Responsible Investment. This is an investor initiative born out of the United Nations Global Compact. It lays the foundational principles for how the investment community can drive progress on world challenges through their investment decisions. Climate Action 100 is an investor initiative to ensure the world's largest corporate greenhouse gas emitters take necessary action on climate change. The We Mean Business Coalition is catalyzing business action and driving policy ambition to accelerate the zero carbon transition. Corporate Initiatives. RE100 is a global initiative bringing together the world's most influential businesses committed to 100% renewable electricity. The United Nations Global Compact is a voluntary initiative based on CEO commitments to implement universal sustainability principles and to undertake partnerships in support of UN goals. And the Sustainable Purchasing Leadership Council convenes buyers, suppliers, and public interest advocates to develop programs that simplify and standardize sustainable purchasing efforts by large organizations. If companies are a part of these initiatives, it signals they have a certain degree of ESG maturity. The impacts of these initiatives have led to both investors asking for more content and disclosure on, and corporations to further develop the following. Corporate purpose. Viewed as a key contributor to the human aspects of competitive advantage, a company's purpose, beyond profits, is important for corporations to develop and for investors to understand the thinking behind. It's this purpose that will provide insight into corporate behavior, decision-making, and long-term resilience. Scenario planning for the 2-degree temperature rise. Climate scientists have determined climate catastrophe is inevitable if global temperatures rise above 2 degrees. Companies are now expected to and are working on scenario planning if and or when that happens. Detailed disclosure on navigating physical, transition, and market labor risks are becoming boardroom priorities. Translating societal risks to business opportunities. Ultimately, investors and corporations alike recognize the vast amount of ESG-related risks and world challenges. Both investors and corporations are looking to challenges like natural resource scarcity and economic inequities as opportunities to launch new ventures that address the challenge through profitable, market-based solutions. Now that we've done a deep dive into ESG 101, it's your turn to apply theory to practice with a final case study exercise. This course has covered the essential basics of ESG, environmental, social, and governance, about managing risks while capitalizing on opportunities inside of a company's operations. The environmental, social, and economic conditions within which a business operates are increasingly becoming the source of material significance. Material issues are not created equal. The majority of material issues will be industry specific and conducted through a materiality assessment that is critical to corporate ESG performance. Material information is how companies are evaluated. Today, external stakeholder pressures are raising the bar on ESG performance expectations. Stakeholder engagement is key to ensuring alignment across all parties, all of whom can directly influence a company's success. And in this course, we covered how ESG can be viewed through a specific framework. Creating the right ESG framework can provide a competitive advantage in the marketplace for almost all companies. ESG performance improvements will directly influence operational, commercial, reputational, and regulatory risks and opportunities.